In this presentation, we will enter an adjusting entry related to unearned revenue within QuickBooks Pro 2019. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are in the home page. We currently have the open windows open. You can open the open windows by going to the view dropdown and selecting the open windows list. In order to see what we're going to do here, we want to go to the reports, the balance sheet first by selecting the reports dropdown. We're going to go down to the company and financial and down to the balance sheet. We'll change the date range on the balance sheet by going to the customize reports up top. We're going to change the dates from 01/01/19 to 02/28/19, our cutoff being February 28th. We're going to say OK. Now what we have here is we got an adjusting entry that's going to be related to unearned revenue. Unearned revenue is it's going to be a little bit different the way we have it here within QuickBooks than the way you typically would see it in a textbook problem. Within a textbook problem, if we had unearned revenue, then first we'd want to know where the unearned revenue came from and then figure out what we're going to do with it. Meaning, usually in a textbook problem, we would have an account, if it was an adjusting entry account, called unearned revenue. It would be an other current liability account, and we would have to say, well, where did that other unearned revenue come from? And then how can I adjust for that unearned revenue? So what is unearned revenue? It could also be like a deposit. It might be called a deposit or something like that, depending on the type of company. To think about that, let's first go to the home page over here and look at the normal process of what normally happens. For most businesses, when do we recognize revenue? When we do the work. That's when we recognize revenue. So there's three ways that we can have revenue compared to cash. Either we did the work before we got the revenue, in which case we would invoice the customer, debit accounts receivable, increase accounts receivable, and increase revenue. And then we would receive payment, decrease in accounts receivable, and receiving payment at that point in time. Or we might do the work at the same time we get paid. So you can imagine this being like this first example being like a bookkeeper or a law firm or a CPA firm doing work and then billing the client. Second, we could do work at the same time, like a restaurant or something like that, where we do the work at the same time. And in that point, we would debit or increase revenue, cash, and increase revenue at the same point in time. So those are the two normal type of things for most businesses. But it's also possible for us to get paid before we do the work. And this would be the case if we had a concert or something like that. We're selling tickets, we get paid before the concert. Or if we have any subscription, which are big now in terms of applications, computer applications, if we get paid for future service that's going to be given in terms of computer applications, or it used to be the prime example was magazines or newspapers where we get paid for a subscription basis. In those industries, we get money before we give the services, and therefore we have to do something different. These two don't cover that scenario. Doesn't happen often for most businesses, but it does happen sometimes. In our case, we may ask for a deposit on a guitar as we order the guitar, so that we get a partial payment up front. We got paid before we ordered the guitar. That's why it might be called a deposit. So that's what we're going to have here, is we got paid before, and there's no button here that really does that for us. Now, in a book problem, what would we do? We would debit cash, and we would credit an unearned revenue of some kind, because it would be a liability. It would be something we would owe in the future. We owe either the money back or we owe the service, if in our case the guitar that we had promised to pay to buy, or the application that we promised to give, or the newspaper. So that would be what would normally happen. Now in our case, if we do that, the unearned revenue, if we don't use one of these items here, the unearned revenue would be not tracked in the customer field, because we would have to make an unearned revenue liability, and the liabilities account isn't the account that tracks our customer, because it's a customer that gave us the money. So in QuickBooks, oftentimes one workaround to deal with that problem is to actually use the receive payments instead of recorded in a new account as a liability. This receive payments, remember what this does is it debits or increases cash, unearned, undeposited cash, and it credits the accounts receivable. It credits accounts receivable. It doesn't credit or increase the liability. It decreases the receivable, the asset. It doesn't increase the liability. So this doesn't do what we would think or would be the most proper thing to do from an accrual basis, which would be to increase a liability if it was unearned revenue. Instead, it decreases an asset. So why would we do that? And the answer to that is because the sub account is backing up accounts receivable. So we would like to see the information on the sub account, the sub ledger by customer, which can be done if we use accounts receivable as the account. So in our problem in practice, it could be the case where this is the way that a company is working around this so that they can basically track customers who have prepaid in the same reports as all other customer reports. So let's take a look at how that might look. If we go back to the balance sheet, we're going to say, let's take a look at this accounts receivable account and see if any of this receivable, it's a positive balance here, which makes sense. People owe the company money. Let's go to the customer accounts and see if any of them look funny. See if any of them are negative. And so we're going to go up top and we're going to go to the customers and receivables. We're going to go to the customer balance detail. And then, well, we don't need to change the date range, but so this Anderson doesn't, the balance is the same here, 10,974. That's what's on the balance sheet. That looks normal. If we go back to the customer balance here, we're going to say who owes us money. Well, this person owes us money. Person owes us money. That makes sense. This all makes sense. Looks good. These are all positive numbers. That would make sense. Here, and then we got this one down here, string guitars is negative 300. That doesn't make sense because it's a negative receivable. That means a negative receivable. What does that mean? That means we owe them money? How does that happen? And that's going to happen because the payment was made here before we gave the invoice. And the reason why we would do that is because now we can see on the receivable, there's the payment. And when we make the invoice at the later, meaning when we buy the guitar, when we receive the guitar, then when we make the invoice to give it to the customer, going back to the home page, we can make an invoice or we can make a sales receipt that we can apply that credit to because that credit is being tracked in the customer area. So that's the benefit from a side in terms of just logistics within QuickBooks software of allowing us to have a negative receivable. So if we go back to the customer detail, this negative receivable can be kind of an easy way for us to match things out in the system. So that is okay as long as the next invoice comes in and we match it out before we display our financial statements to somebody else. Say we want to give the financial statements to a bank or we're doing our quarterly financial statements or whatnot. If they haven't yet paid us yet, then this negative receivable is kind of not proper in terms of accrual accounting. In other words, this 10,974 should be increased by that 300, and this shouldn't be a negative receivable, but a positive liability. So logistically, this works for us because it helps us to track in the customer balance detail, which is supporting the accounts receivable account, not the unearned revenue account, the liability account. Therefore, it's beneficial logistically to put into the customer balance detail in order to have that usage to apply the credit in the same reporting area. However, if we're going to report our information on an accrual basis, we want to make sure we go through these areas and do what is proper, which is to not net out these prepayments in the asset account, but to break them out as liabilities. So that's the adjusting journal entry we'll do here. So it'll be a little bit different than the traditional unearned revenue journal entry you might see in a book problem, which would say, here's how much unearned revenue we have, how much of it have we now earned during this time period. And we would have to increase revenue for the amount earned and decrease the liability. Here we're saying we still have this unearned revenue in a net receivable. We need to take it out of there and represent it as a liability as opposed to a decrease in an asset. So journal entry is going to be to increase the accounts receivable and to increase this liability, which we're going to call unearned revenue. Now we could do this by going to the customary way would be to go into companies up top and make a journal entry. As of the cutoff date, 2/28, we would debit the accounts receivable and credit the unearned revenue. Now we're going to try to do this with registers again to try to avoid the debits and credits. We will see the debits and credits and be back to here, and traditionally the debits and credits would be the way to enter these adjusting journal entries. So we will look at the debit and credit. I'm going to close that back out, and we're going to go into the accounts up top, the register. We could go to the banking and use register and select the drop down. Now we could use accounts receivable, but because that's kind of a special account, the register there could be a little tricky. So the other side of this is going to actually be a balance sheet account too, and that's going to be for the unearned revenue. And we don't have that. That's going to be a liability. It's not here yet. So we're going to have to make unearned revenue. And so we'll use that register. So I'm going to close this back out, and to make that account, we'll go to lists up top, and we'll go to chart of accounts. And we're going to create a new account. It's going to be a current liability account. It's going to be a other current liability account down here. And it's going to be called unearned revenue because we got cash, but we can't call it revenue yet because we haven't earned it. We haven't done the work yet. So we're going to select this account drop up. We're going to say new up top. And we're going to call it, I'm going to select this drop down, and we're going to call it an other current liability type of account. And we will continue. And then it's other current liability. Account name is going to be unearned revenue. Hopefully that's correct. And then we have the sub account that we don't need anything there, no description. None of this other data is something that we will need, so we're going to say save and close. So there we have our new account. Now we're just going to double click on it, and we'll get to our register. We'll enter this into the register, and we're going to say as of 2/28, the end of the time period, end of our cutoff date. And unearned revenue is a liability, and it's going to increase. We're going to increase the liability here. And so we're going to say 300 increase. And then the other side is going to go to accounts payable. So the other side is going to, or accounts receivable, which we can do with the drop down here, accounts receivable, which will be up top. Or we can just type in accounts receivable. Now normally you would need, and then we'll say adjusting entry, let's just say ADJ is what I've been using, ADJ for unearned revenue. Now normally you would need a customer here in order to record anything to the accounts receivable. So let's see what happens when we hit the record here and see if it lets us record this transaction. And it says, no, please choose a customer when using the accounts receivable as a line item. And then we say, well, there's no customer field. Well, how do I do that? What am I going to do here? Well, let's try to select a split item down here. And that usually would be used if there was more than one account that we're working with here. So we're going to say split, and that'll give us some more fields. So we'll say here, I'm going to actually copy this adjusting entry, and we'll put that there in the memo. And now we have the customer field here. So we're going to select the customer. And I think it was, let's go back to, just to make sure, to the customer balance detail. It was for string music. So we'll go back to our register, unearned revenue, register, looking for string music. So we can find down here, it should be the last one. I'm going to type it in, string music, and there we have it. So let's record that. And note, it is recorded, it is a journal entry. So if we go on that journal entry, here it is. So remember that the QuickBooks doesn't have anything that's a standard form for these adjusting entries. It's really just a journal entry, even if we use the register. So everything's a journal entry, really. All the forms are journal entries as well. But this one will be labeled journal entry because there's no other form like a bill or an invoice to record it. So we're going to debit the accounts receivable and credit the unearned revenue. So that's what we have, and we're going to say save and close. Let's close this out, and here's we'll keep that open. Chart of accounts, I'll close this out. Just closing it. So now we've got these open. We're going to go to the balance sheet. So now in accounts receivable, if we double click that item, we'll see that we have this adjustment now. So to string music and accounts receivable, unearned revenue is the other side, and it increased the accounts receivable. So, and that's because it was netting down for that negative balance for that particular customer. And then we're going to close that back out. The subsidiary account then, that adds up to $11,274. If we go to the customer balance detail, still adds up now to $11,274. So this supporting document is really what it's all about. We want to be able to track this by customer, and QuickBooks forces us to do that. You notice QuickBooks will not let us report something typically. I mean, we have to do something drastic for QuickBooks to be able to record something to accounts receivable without assigning a customer. So it really makes us have this tie out, which is nice because it should. So then that makes, we basically netted this back out. And then if we go, so that means that string music, it doesn't look like we owe string music money in the accounts receivable. And then if we go to the other side of this, back to the balance sheet, to the liability account for unearned revenue, there it is, there's the 300. If we double click on that, then now we have the accounts receivable. Here we owe the money. Now again, this here doesn't show on any backup report. And that's the problem with it. This is really related to a customer because this is a liability in a liability account. We have no kind of subsidiary tracking for this as we would if it was in accounts receivable because it's really related to a customer. So that's going to be this item. So this is properly reported now for reporting purposes, but it's a little bit less easy to use logistically. So how can we fix that? We want to fix the system so that the accounting process isn't going to be messed up but by our adjusting entry. And the way we'll do that is we'll just do a reversing entry as of the first day of the next month. So this works for reporting purposes. And also note that the dollar amount's not very large here. So you might say it's a big deal. It's not very large, but it could be a larger dollar amount. It depends on the industry we're in. We might have a lot of customers where we have deposits on the books, and it might be worthwhile for us to break out. And a reader of the financial statements might want to know not just the net assets, but what the accounts receivable is and what the unearned revenue is, what we owe in terms of the unearned revenue. So it could be relevant to break out. But it's also something that we don't want the accounting department to have to worry about our adjusting entry. So we will do a reversing entry typically as of the first day of the next month to go back to the system that we were at, getting rid of unearned revenue, putting it back as a negative receivable. And that way, when we make the invoice, then the invoice will net out, and this report then will make it go down to zero. So we want to be able to make an invoice or a sales receipt which will match up against this negative 300. So we'll make another entry here which will be reversing this back, taking us back to where we were with that negative 300. Then the accounting department, when they make the invoice or sales receipt, will match it up against that negative 300, and everything will be fine going forward. For more accounting information and accounting courses, visit our website at accountinginstruction.info.